Chapter, Executive Summary. Section, Executive Summary. The global commodity market is poised for significant shifts in the coming years, according to the latest forecasts from the World Bank. The report, Commodity Pricing Outlook by World Bank 2024, paints a complex picture of the factors shaping the trajectory of commodity prices across various sectors. One of the key takeaways is the anticipated decline in overall commodity prices, with a projected decrease of 5% in 2025 and 2% in 2026, following a softening of 3% this year. This downward trend is expected to push aggregate commodity prices to their lowest levels since 2020, a notable milestone in the market's evolution. The primary driver behind this projected decline is the expected decrease in oil prices. The Brent crude oil price is forecasted to average $80 per barrel in 2024, before slipping to $73 per barrel in 2025 and $72 per barrel in 2026. This multi-year decline in annual average oil prices is a significant development, with prices settling just slightly above their 2021 levels. However, the report also highlights the potential risks to this outlook, particularly the possibility of escalating conflict in the Middle East. Such geopolitical tensions could lead to a substantial near-term upside risk to energy prices, with potential knock-on consequences for other commodities. The report emphasizes that this represents a substantial threat to the projected downward trend in commodity prices. Offsetting the projected decline in oil prices, the report notes a more stable outlook for natural gas and metals, as well as agricultural raw materials. This divergent trend across different commodity sectors underscores the nuanced nature of the global commodity landscape. Looking ahead, the report cites several longer-term dynamics that suggest sizable downside risks to oil prices, particularly if the OPEC+ group unwinds its latest production cuts. These factors include decelerating global oil demand, notably in China, as well as diversifying oil production and ample supply capacity held by OPEC+. The report also acknowledges the potential for two-sided risks to industrial commodity demand, stemming from economic activity. On the one hand, concerted stimulus in China and above-trend growth in the United States could push commodity prices higher. Conversely, weaker than anticipated global industrial activity could dampen commodity demand and prices. In conclusion, the Commodity Pricing Outlook by World Bank 2024 paints a complex picture of the global commodity market, with a projected decline in overall prices driven primarily by a softening in oil prices. However, the report underscores the presence of significant risks and uncertainty, ranging from geopolitical tensions to the evolving dynamics of supply and demand across various commodity sectors. As the world navigates the post-pandemic economic landscape, stakeholders in the commodity market will need to closely monitor these developments and adapt their strategies accordingly. Section, The State of Commodity Markets. Here is a technical article based on the text from your book, Commodity Pricing Outlook by World Bank 2024, Chapter, Executive Summary, Section, The State of Commodity Markets. The global commodity markets have been in a state of flux over the past few years, marked by a complex interplay of supply and demand dynamics, geopolitical tensions, and macroeconomic factors. The World Bank's Commodity Pricing Outlook for 2024 paints a nuanced picture of the challenges and opportunities facing the industry. One of the key trends highlighted in the report is the ongoing volatility in commodity prices. Factors such as the COVID-19 pandemic, the Russia-Ukraine conflict, and the lingering effects of the global economic slowdown have contributed to significant price fluctuations across a range of commodities, including energy, metals, and agricultural products. This volatility has posed significant challenges for producers, traders, and consumers, who have had to navigate the uncertainty and adapt their strategies accordingly. Another notable trend is the growing emphasis on sustainability and environmental considerations within the commodity markets. Increasingly, consumers and policymakers are demanding more transparency and accountability from commodity producers, pushing them to adopt more sustainable practices and reduce their carbon footprints. This shift is driving innovation and investment in areas such as renewable energy, sustainable agriculture, and circular economies, as players in the industry seek to position themselves for long-term success in a rapidly evolving landscape. The report also underscores the importance of diversification and risk management in the face of these complex market dynamics. Successful players in the commodity markets are those that have been able to effectively diversify their portfolios, mitigate their exposure to price volatility, and adapt their business models to capitalize on emerging opportunities. This may involve exploring new geographic markets, investing in alternative asset classes, or developing more sophisticated hedging strategies. Moreover, the report highlights the growing role of technology in data analytics in the commodity markets. The proliferation of digital platforms, advanced analytics, and machine learning is transforming the way that market participants gather, process, and act on information. By leveraging these technological innovations, companies can gain deeper insights into market trends, optimize their supply chains, and make more informed decisions. Looking ahead, the World Bank's commodity pricing outlook for 2024 suggests that the challenges facing the industry are likely to persist, with ongoing geopolitical tensions, shifting consumer preferences, and the need for sustainable practices all shaping the future of the commodity markets. However, the report also identifies several opportunities for growth and innovation, from the transition to renewable energy to the development of more resilient and efficient supply chains. To navigate this complex and dynamic landscape, industry players will need to embrace a more holistic and strategic approach, one that combines a deep understanding of market fundamentals, a commitment to sustainability, and a willingness to leverage the power of technology and data. By doing so, they can not only weather the current storms but also position themselves for long-term success in the rapidly evolving world of commodity markets. Section: Outlook. The World Bank's Commodity Price Index is expected to experience a softening trend in the coming years, reflecting an overall decline in aggregate commodity prices. After a 3% decline in 2024 compared to the previous year, the index is projected to retreat by an additional 5% in 2025 and 2% in 2026, as illustrated in Figure 2.a. This projected downward trajectory would lead to commodity prices reaching their lowest level since 2020, though they would still remain nearly 30% above the 2015 to 2019 average. The underlying factor driving this overall decline is the improvement in supply conditions across various commodity markets. Coupled with the expectations of moderate global economic growth, these supply-side improvements are giving rise to generally modest price movements, except in cases where individual commodity markets are responding to specific developments unique to those markets. This suggests a more balanced and stable commodity price environment in the coming years, as the global economy navigates a period of cautious expansion. It's important to note that while the aggregate trend points to a decline, the price projections for individual commodities may vary. Some commodities may experience increases, while others may see more pronounced decreases, depending on their respective supply and demand dynamics. This diversified outlook underscores the complex and interconnected nature of the global commodity markets. The World Bank's analysis highlights the importance of closely monitoring supply-side factors and global economic conditions in order to anticipate and adjust to the evolving commodity price landscape. Policymakers, industry stakeholders, and consumers alike will need to remain vigilant and adaptable to navigate the challenges and opportunities presented by these shifting market dynamics. As the world grapples with the aftermath of the COVID-19 pandemic and the ongoing geopolitical tensions, the World Bank's commodity price forecasts provide valuable insights into the potential trajectory of the global commodity markets. By understanding these trends, decision-makers can better prepare and position themselves to manage the risks and capitalize on the opportunities that may arise in the coming years. Section: Energy Prices. The World Bank's commodity pricing outlook for 2024 paints a nuanced picture of the global energy landscape in the coming years. The report's projection of a decline in the energy price index by 6% in 2024, followed by further drops of 6% in 2025 and 2% in 2026, suggests a gradual easing of energy costs. Underpinning this forecast is the assumption of a stable global economic growth and the continued expansion of oil supply from non-OPEC plus producers. The report also anticipates OPEC plus countries maintaining elevated spare capacity and delaying the reversal of voluntary supply cuts, which would help mitigate potential supply disruptions. Brent crude oil prices are expected to hover around $75 per barrel for the remainder of 2024, averaging $80 per barrel for the year overall, before declining to an average of $73 per barrel in 2025 and $72 per barrel in 2026. This projected decline in annual average oil prices over 4 consecutive years would see them settle just slightly above 2021 levels, indicating a normalization of the market after the price volatility experienced in recent years. The report's analysis of global oil supply and demand paints a nuanced picture. Global oil supply is expected to reach approximately 105 million barrels per day, MB/D, in 2025, up by 2 million barrels per day from 2024. This increase is anticipated to come primarily from Brazil, Canada, Guyana, and the United States, with OPEC plus production only edging up. On the demand side, global oil consumption is forecast to rise by about 1 million barrels per day per year in 2024 to 25, representing an annual growth rate below 1%. This would mark a significant slowdown from the 2 million barrels per day increase observed in 2023 and continue a longer-term global deceleration, with the growth of global oil consumption averaging 1.4% over 2015 to 19. Under these conditions, global oil supply is expected to exceed demand by an average of 1.2 million barrels per day in 2024, surpassing the degree of oversupply seen only during the COVID-19 related shutdowns in 2020 and the 1998 oil price collapse. The report highlights that demand growth in China and India will comprise nearly half of the envisioned increase in 2025, while consumption in advanced economies is set to decline marginally. In 2026, growth in global oil consumption is expected to be broadly unchanged from the previous 2 years. The report also addresses the European natural gas market, which is projected to see the European natural gas benchmark 18% lower, on average, in 2024 than 2023, as the market continues to adapt to the reconfiguration of supply following Russia's invasion of Ukraine. After several years of dramatic swings, European gas prices are expected to increase by a moderate 7% in 2025, year-over-year, before declining by a slightly larger magnitude in 2026 as supply increases. In contrast, the U.S. natural gas price is expected to decline in 2024, reflecting elevated production and large inventories. However, prices are projected to climb markedly in 2025 to 26, as new infrastructure allows U.S. exports to increasingly serve growing global demand, generating upward pressure on domestic prices. The report's outlook for coal prices is also noteworthy, with projections of a decline throughout the forecast period as global consumption declines, led by China. Overall, the World Bank's commodity pricing outlook for 2024 provides a comprehensive and nuanced analysis of the global energy landscape, highlighting the complex interplay of supply, demand, and geopolitical factors that will shape the industry's trajectory in the coming years. Section: Metals Prices. The metals market is poised to experience a nuanced shift in the coming years, according to the World Bank's commodity pricing outlook for 2024. The report projects a slight downward trend in the overall metals price index over the 2025 to 26 period, despite a solid 6% increase observed this year. Base metal prices are expected to hold steady next year, before softening by 3% in 2026. This relatively muted trajectory is largely attributed to the moderate growth anticipated in the industrial activity of major economies, particularly China. The report suggests that the global demand for base metals may not exhibit a sharp increase, leading to a more balanced supply-demand dynamic and a subsequent stabilization of prices. In contrast, the outlook for iron ore prices paints a different picture. After a significant 10% drop this year, the report forecasts further declines in 2025 to 26 as major producers expand their output and new mines come online. This supply-side expansion is expected to outpace the demand growth, exerting downward pressure on iron ore prices. The precious metals segment, on the other hand, presents a more robust and intriguing scenario. The precious metals price index is projected to plateau around record annual levels in the coming years, following a substantial 21% increase this year. This sustained elevated price level is largely attributable to the performance of gold, which has broken price records in 2024. The driving forces behind gold's remarkable performance are multifaceted. Both official demand from several emerging market and developing economy (EMD) central banks, as well as private demand, have been bolstered by declining U.S. interest rates and heightened geopolitical tensions. These factors have created a favorable environment for gold, leading to its surge in prices and the overall strength of the precious metals market. The World Bank's Commodity Pricing Outlook provides a comprehensive analysis of the global metals market, offering valuable insights into the nuanced dynamics shaping the future of this critical industry. The report's findings suggest that while the base metals and iron ore segments may experience relatively muted or even softening price trends, the precious metals market, particularly gold, is poised to maintain its prominent position and potentially set new benchmarks in the years ahead. Section: Agricultural Prices. Commodity Prices, a Cautious Outlook for 2025 to 2026. The World Bank's Commodity Pricing Outlook for 2024 paints a nuanced picture of the global commodity market in the coming years. According to the report, agricultural prices are expected to experience a moderate decline in 2025, followed by little change in 2026. The primary driver behind this anticipated decrease is the projected increase in supply, driven by favorable weather conditions. This is particularly relevant for the food commodity segment, which includes grains, oils, meals, and other food items. The report forecasts a 9% decline in food commodity prices in 2024, followed by a further 4% softening in 2025 before stabilizing in 2026. This anticipated drop in food prices is a positive development, as it should help improve overall food affordability, particularly in emerging markets and developing economies, EMDEs. The report also notes that while growing conditions in major cocoa and coffee regions are likely to improve, prices for these commodities are expected to remain elevated compared to historical standards. Turning to the energy sector, the report suggests that a projected decrease in oil prices is primarily driven by steady supply growth set against decelerating global oil demand. This trend is supported by the analysis of the changing dynamics in China's oil consumption, which is a significant driver of global demand. Meanwhile, the outlook for gold prices remains more optimistic, with the report indicating that they are likely to remain elevated in 2025, buoyed in part by strong central bank demand. However, the report also highlights the presence of notable upside risks to commodity prices, particularly in the near term, due to heightened geopolitical tensions. This could significantly impact the energy and broader commodity markets. Over the forecast period, the report suggests that the risks to commodity prices are slightly tilted to the downside. This is primarily due to the potential for considerable excess oil supply if the OPEC+ group adheres to its current production schedule. Furthermore, the report identifies two-sided risks to global economic activity, especially in China, as a further source of commodity price uncertainty. In conclusion, the World Bank's Commodity Pricing Outlook for 2024 presents a cautious yet nuanced perspective on the trajectory of commodity prices in the coming years. While the overall trend points to a moderate decline, particularly in the agricultural and energy sectors, the report highlights the presence of both upside and downside risks that could significantly impact the market dynamics. Section: Risks. The global commodity market faces a complex set of risks and uncertainties in the coming years, as highlighted in the excerpt from the Commodity Pricing Outlook by World Bank 2024 report. The primary concern revolves around the potential for escalating conflict in the Middle East, which could have significant implications for energy prices. The report suggests that a conflict-related reduction in the region's energy exports could lead to a sharp increase in oil and gas prices, not only in the closing months of 2024 but also well into the following year. This price surge would have far-reaching consequences, rippling through other commodity markets and potentially disrupting the broader economic landscape. Beyond the geopolitical risks, the report also identifies two other upside risks to commodity prices. The first is the prospect of stronger-than-anticipated economic growth, particularly if driven by policy stimulus measures in China. Such a scenario could fuel robust demand for a wide range of commodities, potentially outpacing supply and exerting upward pressure on prices. The second upside risk is the potential for supply disruptions due to climate change-related extreme weather events. As the impacts of climate change become more pronounced, the likelihood of severe weather patterns that disrupt commodity production and distribution channels increases, leading to price volatility. However, the report suggests that the overall risk profile for commodity prices is slightly tilted to the downside over the forecast horizon. This assessment is based on the expectation that the steady unwinding of OPEC+ production cuts, in line with announced policy, could generate abundant oil supply, significantly reducing oil prices and, by extension, lowering commodity prices more broadly. Additionally, the report highlights the risk of weaker-than-expected global industrial activity, which could exert downward pressure on energy and metal prices. This could be a result of various factors, such as a slowdown in economic growth, trade tensions, or shifts in manufacturing and consumption patterns. The complex interplay of these risks and the potential for both upside and downside price movements underscores the need for policymakers, industry participants, and market analysts to closely monitor the evolving global commodity landscape. Careful evaluation of these factors, along with proactive risk management strategies, will be critical in navigating the uncertain terrain ahead. Section: Upside Risks. Geopolitical tensions and commodity pricing outlook. Navigating risks and opportunities. The recent surge in tensions in the Middle East, accompanied by a rapid rise in oil prices, serves as a stark reminder that broader conflicts remain a significant risk factor in commodity markets. Should intensifying conflicts lead to damage to the oil and gas infrastructure of major commodity producers, the resulting energy price shocks could have far-reaching implications. To assess the potential impact of a geopolitics-driven supply disruption, the World Bank has considered a scenario in which global oil supply declines by 2 million barrels per day (MB/D) due to a conflict-related shock in late 2024. A shortfall of this magnitude, equivalent to approximately 2% of global oil production, would be comparable to historical oil supply decreases seen during the Iraq War in 2003 and the Libyan Civil War in 2011. In this event, oil prices would rise sharply, with the price of Brent crude oil reaching close to $92 per barrel at the peak impact, similar to the monthly high observed last year. However, as unaffected oil producers respond to the higher prices by increasing production, oil prices would gradually decrease over the course of 2025, although remaining above the pre-escalation level. For 2025 as a whole, the price of Brent oil is projected to average $84 per barrel, 15% above the baseline forecast but only 5% above the average 2024 price, as price declines are expected in the second half of the year. The potential ramifications of an energy supply shock, however, extend beyond the oil market. Such a disruption could also have repercussions for a wider range of commodity prices, including agricultural and fertilizer products, as energy commodities serve as key production inputs, and biofuels as crude oil substitutes. Furthermore, depending on the specific permutations of conflict escalation, the energy market impacts could be larger than envisaged, particularly if critical energy trade routes were compromised. Alongside geopolitical tensions, the commodity price outlook is also influenced by the potential for stronger global GDP growth. While the current forecasts do not anticipate any broad demand impetus from fluctuations in economic activity, the possibility of higher-than-expected growth in China and the United States, the world's two largest economies, presents an upside risk. If China's policymakers intensify stimulus efforts to bolster output growth prospects, industrial commodity prices could increase substantially, as the pace of economic growth in China has historically been a key driver of commodity markets. Additionally, above-trend GDP growth in the United States, despite an anticipated slowdown, could also contribute to higher commodity prices. Furthermore, the escalating impacts of climate change, as evidenced by the global average temperature exceeding pre-industrial levels by more than 1.5 degrees Celsius, pose a significant risk to commodity supply. Extreme weather events, such as heat waves, can lead to yield losses in agricultural markets, compromising supply and pushing prices above their forecast levels. In the energy sector, more frequent and prolonged heat waves could impact hydropower output and increase demand for other energy sources, such as natural gas and coal, leading to higher prices. In conclusion, the commodity pricing outlook is subject to a multitude of complex and interrelated factors, ranging from geopolitical tensions and supply disruptions to economic growth dynamics and the effects of climate change. Navigating these risks and uncertainties will require a nuanced understanding of the underlying drivers and a proactive approach to risk management. As the global economy continues to grapple with these challenges, the need for robust and adaptable commodity pricing strategies has never been more pressing. Section: Downside Risks. The global oil market has been an area of significant interest and volatility in recent years. The World Bank's 2024 Commodity Pricing Outlook, specifically the Downside Risks section, highlights several key factors that could impact the future trajectory of oil supply and prices. One of the primary concerns outlined in the text is the potential for increased oil supply from OPEC+ countries. The group has maintained its agreement, first reached in late 2023, to implement voluntary oil supply cuts of 2.2 million barrels per day (MB/D), in addition to 1.65 million barrels per day of prior cuts. However, the duration of these voluntary reductions has been repeatedly extended as oil demand has undershot OPEC+ forecasts. The World Bank's baseline projections assume that the majority of these OPEC+ output cuts will be retained until the end of 2025. But the text also explores an increased oil supply scenario, where the 2.2 million barrels per day of OPEC+ voluntary cuts are unwound during 2025, as per the announced policy but contrary to the baseline assumptions. In this scenario, global oil production would be expected to markedly exceed demand in 2025, leading to a significant buildup in global oil stocks. This ample supply, coupled with modest demand growth, would exert sustained downward pressure on oil prices, with the Brent oil price projected to decline to an average of $66 per barrel, BBL, in 2025, around 10% below the baseline forecast and 18% lower than the projected 2024 average price. The text also highlights another potential downside risk: weaker global industrial activity. In the context of still elevated interest rates and subdued global trade growth, recent data releases indicate potential downside risks to global industrial activity. For example, the euro area has experienced contracting industrial production for most of 2024, while global manufacturing purchasing managers' indices, PMIs, for output, new orders, and new export orders signaled contraction in the third quarter of 2024. Additionally, protracted domestic demand weakness in China, partly stemming from a persistent drag from the commodity-intensive construction sector, could lead to GDP growth in China underperforming forecasts. The materialization of these downside risks to global industrial activity would significantly dampen associated commodity demand, including for oil, leading to further declines in commodity prices. The text from the World Bank's 2024 Commodity Pricing Outlook highlights the complex and interconnected nature of the global oil market. The potential for increased oil supply from OPEC+ countries, coupled with weaker global industrial activity, could create significant headwinds for the oil market, leading to a more challenging pricing environment in the years ahead. Policymakers, industry stakeholders, and market participants will need to closely monitor these developments and adapt their strategies accordingly. Section: Broader Implications. The broader implications of commodity price forecasts. The World Bank's commodity price forecasts for 2024 have significant implications for the global economy. As energy and food commodity prices are projected to decline, these price movements will have a profound impact on consumer price inflation, food security, and broader economic dynamics. One of the primary implications is the potential for lower headline inflation, particularly in emerging market and developing economies, EMDEs, where energy and food expenditures make up a substantial portion of the consumer price index. As the pass-through of lower commodity prices to consumer prices occurs, central banks in these economies may find it easier to bring inflation back towards their respective targets. This could be particularly beneficial in regions where high inflation has been a persistent challenge, eroding the purchasing power of households and constraining economic growth. The easing of commodity prices may also help temper inflation expectations, further contributing to reduced core inflation pressures. However, the relationship between global commodity prices and food security is becoming increasingly complex. While declining food commodity prices are likely to improve food affordability in EMDEs, the prevalence of localized food crises driven by factors such as conflicts, natural disasters, and idiosyncratic economic shocks presents a continuing challenge. Despite the projected price declines, the global incidence of undernourishment has remained elevated, affecting over 730 million people globally in 2023. Looking ahead, the UN Food and Agriculture Organization expects the number of individuals experiencing undernourishment to rise further, reaching 735 million by 2025. Risks to the commodity price forecasts also carry significant implications. A conflict-driven spike in commodity prices, particularly in the energy and food sectors, could reignite concerns about above-target inflation in many economies. This could lead to a paring back of expectations for interest rate cuts, potentially tightening global financial conditions and constraining consumption growth as real household incomes are squeezed by rising prices of essential goods. Conversely, a larger-than-expected increase in oil supply could represent a positive commodity-specific supply shock, reducing energy prices and potentially boosting global demand through increased real incomes for consumers and reduced industrial input costs. However, the net benefit to global economic activity may be relatively modest, as factors such as declining extractives investment in the United States, limited pass-through of crude oil price declines to consumers, and pro-cyclical policy tightening in some oil-exporting countries could dampen the positive effects. These broader implications of the World Bank's commodity price forecasts underscore the complex and interconnected nature of the global economy. Policymakers and stakeholders must carefully navigate the nuances of these dynamics to maximize the benefits and mitigate the risks associated with fluctuations in commodity prices. Section: Special Focus. The synchronization of commodity prices has been a subject of significant interest in the global economic landscape, particularly in the aftermath of the COVID-19 pandemic and the subsequent recovery period. The World Bank's Commodity Pricing Outlook by World Bank 2024 report delves into this critical issue, shedding light on the complex dynamics that have shaped commodity price movements during this pivotal time. The analysis presented in the report's Special Focus section reveals several key findings that offer valuable insights into the underlying drivers of commodity price synchronization. Firstly, the report identifies a common factor that has played a substantial role in explaining the price movements of industrial commodities, particularly during periods of economic stress. This common factor accounted for a significant portion of the price variations observed for base metals, energy, and food commodities during the 2020 to 2024 period. Secondly, the report highlights the significant and lasting impact of non-commodity global supply shocks on commodity prices, followed by commodity-specific shocks, such as those related to weather or geopolitical events. In contrast, global demand shocks, such as fiscal stimuli, tend to have a more temporary effect on commodity prices. The report further notes a shift in the dominant drivers of commodity prices in the post-pandemic era. While global supply shocks were the primary influencers in the early 2000s and around the global financial crisis, the post-pandemic commodity prices have been substantially shaped by commodity-specific shocks, particularly those related to conflicts. This shift has given rise to novel price patterns, such as precious metals moving more in sync with the common factor, driven by increased safe haven demand. The report acknowledges that while the effects of global shocks on commodity markets have largely subsided, lingering risks remain. Specifically, the report cautions that major supply disruptions in energy and agricultural producing regions could trigger a renewed synchronized upswing in commodity prices, which would have detrimental consequences for global inflation and economic activity. The comprehensive analysis presented in the World Bank's Commodity Pricing Outlook by World Bank 2024 report provides a valuable framework for understanding the intricate dynamics shaping the global commodity market. By identifying the key factors driving commodity price synchronization, the report offers policymakers, industry stakeholders, and economic analysts critical insights to navigate the evolving landscape and implement effective strategies to mitigate the risks and capitalize on the opportunities presented by the changing commodity market dynamics. Chapter: Commodity Market Developments and Outlook. Section: Energy. Here is a technical article that expands on the original text, while maintaining its underlying message. The global energy landscape has been marked by significant volatility and shifting dynamics in recent years, with the commodity markets undergoing a complex and multifaceted transformation. The World Bank's Commodity Pricing Outlook for 2024 provides a comprehensive analysis of the key developments and the projected trajectory of various energy commodities, offering valuable insights for policymakers, industry stakeholders, and market participants. The report highlights that after a 4% decline in energy prices in the third quarter of 2024, the market experienced heightened volatility in October, driven by a confluence of factors. The shifting assessments of geopolitical risks, signs of subdued economic growth in China, and concerns about potential oversupply have all contributed to the increased market turbulence. These factors have led the World Bank to project a 6% year-over-year, dip in its energy price index for 2024, followed by further softening of 6% in 2025 and 2% in 2026. Delving deeper into the oil market, the report outlines the recent developments and the expected trajectory of crude oil prices. The Brent crude oil price is projected to average $80 per barrel, BBL, in 2024, down from $83 per BBL in 2023, and is expected to recede further to $73 per BBL in 2025 and $72 per BBL in 2026. These projections are predicated on several key assumptions, including the continuation of ongoing armed conflicts without further escalation, stable global economic growth, and the extension of the voluntary OPEC+ supply cuts by the vast majority of its members. Additionally, the report anticipates a growth of almost 2 million barrels per day, MB/D, in oil supply from non-OPEC+ producers in 2025. Regarding natural gas prices, the report expects European prices to decrease by 18% in 2024, before a slight uptick in 2025 and a subsequent moderation in 2026. In contrast, U.S. natural gas prices are set to decline in 2024, followed by a sharp climb in the next year and a further edge up in 2026. Coal prices, on the other hand, are projected to fall across the entire forecast horizon. The report also highlights the potential risks to the energy price outlook, both on the upside and downside. A prolonged intensification of the conflict in the Middle East poses significant upside risks to energy prices. Other upside risks include lower than expected North American oil output, increased competition for liquefied natural gas, LNG, cargoes, and sustained, higher than assumed coal and natural gas consumption in Asia. Conversely, substantial downside risks exist, particularly in the form of an earlier than expected unwind of OPEC+ supply cuts, which could lead to abundant oil supply, as well as weaker than expected economic growth, including in China. The analysis of the oil market's recent developments provides further insights into the underlying dynamics. In the first week of October, oil prices surged by 10% to almost $81 per BBL, driven by a marked increase in geopolitical tensions. However, this rise was largely reversed by the middle of the month as concerns over oil oversupply and weak economic growth in China took center stage, while perceived risks to oil infrastructure in the Middle East receded. In the previous quarter, the steady decline in oil prices, from $87 per BBL in early July to about $73 per BBL on average in September, was attributed to a combination of factors. These included disappointing updates on the Chinese economy, heightened expectations of a substantial deceleration in China's oil consumption relative to the previous year, and signs of softening momentum in the U.S. economy. The downward pressure was only partially offset by announcements of easing monetary policy in major economies, short-term disruptions to U.S. oil supply, and a rise in conflict-related concerns in early August. Towards the end of August, perceptions that OPEC+ might start unwinding their voluntary supply cuts in September, as previously announced in June, further pushed the Brent price sharply downward. However, OPEC+ subsequently postponed the unwind of their supply cuts by 2 months. Nevertheless, oil prices continued to fall due to subdued economic data, reaching $69 per BBL in the second week of September, the lowest level since December 2021. Notably, the price of Urals oil has remained above the $60 per BBL price cap agreed by the G7-led price cap coalition, with the recent Brent-Urals differential considerably narrower than in early 2023. This development highlights the ongoing challenges and complexities surrounding the global oil trade and pricing dynamics. The report also delves into the global oil demand and supply dynamics. The growth of global oil demand is estimated to have declined significantly, from 2.4 million barrels per day in 2023 Q3 to 0.7 million barrels per day in 2024 Q3, year-over-year, with the slowdown particularly pronounced in China. This decline in Chinese oil consumption has been driven by subdued industrial production growth, the rapid adoption of electric and hybrid vehicles, and the increasing prevalence of trucks powered by liquefied natural gas, LNG. In contrast, oil demand growth in other emerging market and developing economies, EMDEs, remained stable at around 0.7 million barrels per day in 2024 Q3, with increases observed in East Asia and Pacific, excluding China, the Middle East and North Africa, and South Asia. However, oil demand stalled in Europe and Central Asia and decreased in Sub-Saharan Africa. On the supply side, global oil production rose by 1.1% in 2024 Q3, year-over-year, a slight increase compared to the previous quarter. While production changes among OPEC+ members were generally minor, with the exception of Libya and Russia, overall production continued to increase in advanced economies and Latin America and the Caribbean, more than offsetting the decline in the Middle East and North Africa region. The report also highlights the global spare capacity, which increased in September 2024 to slightly more than 7% of current global production, with Saudi Arabia holding almost half of this spare capacity. Reflecting the OPEC+ supply management, the supply-demand balance in the oil market has remained tight in 2024, with surpluses in the first and second quarters offset by a deficit in the third quarter. In summary, the World Bank's commodity pricing outlook for 2024 provides a comprehensive and insightful analysis of the energy market dynamics, offering a detailed outlook for various energy commodities, including oil, natural gas, and coal. The report's projections and the underlying assessments of risks and uncertainties offer valuable guidance for industry participants, policymakers, and market analysts as they navigate the complex and ever-evolving global energy landscape. Section, Outlook. Here is a technical article based on the provided text from the Commodity Pricing Outlook by World Bank 2024 book. The Brent oil price is projected to average $80 per barrel, BBL, in 2024, about $3 per BBL lower than the previous year. Prices are expected to hover around $75 per BBL for the rest of 2024 before drifting lower to $73 per BBL in 2025 and $72 per BBL in 2026. This projection is predicated on several key assumptions: no prolonged escalation in ongoing armed conflicts, a slowdown in oil demand growth, and a well-supplied oil market. Under these baseline assumptions, global oil supply next year is expected to exceed demand by an average of 1.2 million barrels per day, MB/D, a degree of oversupply only surpassed during the COVID-19 related shutdowns in 2020 and the 1998 oil price collapse. This points to a potential softening of oil prices in the near future, barring any unforeseen supply disruptions or geopolitical tensions. Global oil supply is projected to reach about 103 million barrels per day in 2024, up from 102.3 million barrels per day in 2023, before rising to around 105 million barrels per day in 2025. The majority of the growth in production is expected to occur in the United States, with increases of approximately 0.6 million barrels per day in both 2024 and 2025. Supply is also projected to continue increasing by up to 0.5 million barrels per day a year in Brazil, Canada, and Guyana combined. In 2025, production is also predicted to increase in several smaller producers, such as Kazakhstan, Norway, and several African countries. However, supply from OPEC+ members is assumed to increase only slightly in 2025, based on the assumption that the majority of the 2.2 million barrels per day voluntary cuts will be extended further. On the demand side, global oil consumption is expected to rise by about 0.9 million barrels per day in both 2024 and 2025, a marked slowdown from the 2 million barrels per day increase in 2023, after China lifted pandemic-related policy measures. Up to 45% of the growth in global consumption in 2024 and 2025 is expected to occur in China and India, despite China's increase being only about 1/10 of the rise seen in 2023. In contrast, consumption in advanced economies is projected to stall this year and next. In 2026, the growth in global oil consumption is expected to be broadly in line with the previous 2 years, around 0.8 million barrels per day, with increases remaining concentrated in East Asia and the Pacific, South Asia, and Sub-Saharan Africa. These projections would continue a secular deceleration in global oil consumption, reflecting both the declining oil intensity of global GDP and subdued global economic growth by recent historical standards. Consumption in China will also continue to be dampened by the ongoing rapid diffusion of electric and hybrid vehicles, which recently reached 50% of total monthly vehicle sales, as well as the increasing use of LNG-powered trucks. Overall, the outlook for the global oil market in the coming years suggests a relatively well-supplied and stable environment, with the potential for some downward pressure on prices as supply exceeds demand. However, the projections remain subject to various risks and uncertainties, including the potential for geopolitical tensions, supply disruptions, and the pace of the global energy transition. Section: Risks. The oil market has been experiencing significant volatility in recent years, driven by a complex interplay of geopolitical, economic, and market-specific factors. The World Bank's commodity pricing outlook for 2024 highlights several key risks that could impact the trajectory of oil prices in the near and long term. One of the primary upside risks to oil prices is the potential for heightened tensions in the Middle East. The report notes that the baseline forecast assumes the continuation of relatively small-scale, conflict-related disruptions to oil exports from the region, such as limited attacks on ships in the Red Sea. However, a significant escalation of ongoing conflicts, particularly if they were to spread to major oil-producing countries, could lead to a sharp and sustained rise in oil prices. The report quantifies this risk by considering a scenario in which a conflict-related shock decreases global oil production by 2 million barrels per day (MB/D), equivalent to around 2% of global output. Under this scenario, the Brent crude oil price could surge to close to $92 per barrel, BBL, at its peak, before gradually declining but remaining above the pre-escalation level, with an average price of $84 per BBL in 2025. Another upside risk identified in the report is the potential for U.S. shale oil producers to fall short of expected output growth. The baseline forecast assumes a rise in U.S. oil production of around 0.6 million barrels per day in 2025. However, the report notes that recent data suggests headwinds that could slow the expansion of shale output, including rising input and capital costs, a declining number of active and drilled but uncompleted DUC wells, workforce constraints, and the financial discipline imposed by a wave of mergers and acquisitions in the industry. If these factors persist amid increasing global demand and no supply increase from OPEC+, a shortfall in the market could result, leading to higher oil prices. The report also highlights the potential for robust oil consumption growth in China as an upside risk. The baseline forecast assumes modest oil demand growth in China, reflecting weak economic activity and the continued penetration of electric and hybrid vehicles. However, the report notes that recently announced stimulus measures and the possible introduction of new expansionary fiscal policies could boost business and consumer confidence, leading to higher demand from the industrial and transportation sectors and, consequently, stronger than expected oil consumption growth. On the downside, the report suggests that over the full forecast period, risks are slightly tilted in favor of a sustained period of excess oil supply. Key downside risks include weaker than expected global economic growth and a steady unwinding of OPEC+ supply cuts, broadly in line with the announced schedule, which could generate a larger supply surplus and put downward pressure on prices. The Commodity Pricing Outlook's analysis of the risks facing the oil market underscores the complex and dynamic nature of the global energy landscape. Policymakers, industry stakeholders, and market participants will need to closely monitor these developments and be prepared to respond to the evolving market conditions in the years ahead. Section: Downside Risks. The global oil market is currently facing a complex and dynamic landscape, with a range of factors influencing the supply and demand dynamics. The World Bank's 2024 Commodity Pricing Outlook, in its chapter on Commodity Market Developments and Outlook, delves into the potential downside risks associated with the commodity markets, particularly in the context of increased oil supply. The baseline forecast presented in the report assumes that the OPEC+ supply will remain largely unchanged throughout the rest of 2024 and in 2025. However, this contrasts with the production schedule announced by OPEC+ in September 2024, which indicated that member countries would return 180,000 barrels per day to global markets in December 2024 and an average of 1.5 million barrels per day, in 2025. The report suggests that this production schedule, if implemented, would be consistent with OPEC+ prioritizing market share over price, considering the expanding oil production in non-OPEC+ countries. The report explores an increased oil supply scenario, which assumes that the OPEC+ production schedule, if implemented without reductions in output elsewhere, would create a significant oversupply in the oil market. According to the analysis, with global supply projected to be about 2.5% higher than demand in 2025, the resulting surplus would be comparable to the levels seen during the COVID-19 pandemic in 2020. The report suggests that although other oil producers would likely be pressured to reduce production, the bulging global oil stocks would still exert downward pressure on oil prices in the following year. In this scenario of ample supply and modest demand growth, the report projects that the Brent oil price could decline to an average of $66 per bbl, dollars per barrel, in 2025, which would be approximately 10% below the baseline forecast and 18% lower than the projected 2024 average price. The report also considers the potential implications of an increase in OPEC+ supply and the subsequent price drop. It suggests that this could prompt a delay in production increases elsewhere, such as in Brazil, Canada, and Guyana, where the increase in supplies could be smaller than the 0.5 million barrels per day assumed in the baseline. Additionally, the report indicates that U.S. shale producers could reduce extraction activity, particularly given their increased focus on returns on capital. However, the report notes that with average U.S. shale operating expenses reportedly covered at an oil price as low as $37 per bbl, many U.S. shale oil producers could likely withstand lower prices, which, if realized, would weigh on the fiscal balances of OPEC+ members. The report also addresses the potential impact of weak economic growth on the oil market. It suggests that weaker-than-expected global economic growth, particularly a more pronounced slowdown in China than currently anticipated, would translate into lower oil demand in 2025 and 2026, causing prices to fall below forecasts. The report highlights the challenges faced by China's property sector, with house prices continuing to decline, and the recent close-to-record low business and consumer confidence, coupled with sluggish consumption growth and decelerating manufacturing activity. Overall, the World Bank's 2024 commodity pricing outlook presents a nuanced and comprehensive analysis of the potential downside risks in the oil market, with a focus on the implications of increased oil supply and weak economic growth. The report provides valuable insights for policymakers, industry stakeholders, and market participants to navigate the complex dynamics of the global oil market in the coming years. Section: Natural Gas. Natural gas market dynamics, navigating volatility and shifting demand. The global natural gas market has experienced significant fluctuations in recent years, with the World Bank's Natural Gas Price Index reflecting these dynamic shifts. In the third quarter of 2024, the index saw a 10% increase, quarter-over-quarter, underscoring the complexities and divergent trajectories within the natural gas landscape. One of the key factors contributing to this trend is the divergence among the three price benchmarks within the index. The U.S. benchmark remained relatively stable, showcasing the continued strength of domestic production. Conversely, Japan's LNG prices increased by 8%, while the European benchmark witnessed a more substantial 15% rise. This steep increase in Europe's benchmark can be attributed to the region's heightened global competition for LNG imports, as it grappled with securing adequate supply to meet its energy needs. The widening gap between the European and LNG benchmarks, which narrowed by approximately 40% in 2024 Q3, underscores the complex dynamics at play in the global natural gas market. This disparity reflects the shifting supply and demand patterns, as well as the geopolitical and regulatory factors that shape the market's landscape. Delving deeper into the demand-side dynamics, natural gas consumption experienced a 2.8% increase in 2024 Q1-Q3, year-over-year, with the Asia-Pacific region accounting for 60% of this change. China, in particular, saw a 10% rise in consumption during this period, driven by the government's efforts to enhance energy security and achieve its carbon reduction goals. India, Japan, and the Republic of Korea also contributed to the robust growth in Asian natural gas demand. In contrast, Europe witnessed a decline of approximately 3% in natural gas consumption, primarily due to reduced demand for heating amid milder weather conditions and lower demand from the power sector, where renewable and nuclear sources provided increased output. North America, on the other hand, saw a modest 1.5% increase in natural gas consumption, as low prices continued to stimulate strong demand from the power sector. On the supply side, global natural gas production expanded in the first half of 2024, but the growth rates varied across the major producers. The United States experienced a 1% increase, year-over-year, in production, reflecting the sustained natural gas output accompanying increased oil extraction. Russia's natural gas supply is estimated to have expanded by over 7% in 2024 H1, partially recovering from 2 years of decline. The Middle East also saw steady increases in natural gas production during this period. Interestingly, the global LNG trade grew by around 2.8% in 2024 Q1-3, year-over-year, but the market remained tight. LNG exports from producers in Asia, Russia, and the United States increased, with U.S. exports being redirected from Europe to other regions, including Asia, where prices surpassed the European benchmark. This dynamic highlights the shifting global trade patterns and the evolving competitive landscape in the LNG market. The natural gas market's trajectory was further influenced by inventory levels. Mild winter temperatures in early 2024 led to large accumulations of inventories in the European Union, EU, and the United States. By the end of 2024 Q3, the EU's natural gas inventories were near record highs, positioning the European market to enter the 2024-25 heating season with a substantial buffer. Similarly, inventory levels in the United States remained above their 5-year range due to elevated production. These dynamics in the natural gas market underscore the complex interplay of factors that shape the industry's outlook. Policymakers, industry stakeholders, and market participants must navigate the evolving landscape, balancing supply, demand, and geopolitical considerations to ensure the efficient and sustainable development of the global natural gas market. Section: Coal. Coal market dynamics, navigating price volatility and supply shifts. The coal market has been a subject of significant interest and volatility in recent years, with a range of factors influencing prices and supply dynamics. The World Bank's commodity pricing outlook for 2024 provides valuable insights into the recent developments and the broader outlook for this critical energy resource. In the third quarter of 2024, the price of Australian coal saw a 3% increase, following an 8% rise in the previous quarter. This upward trend continued into early October, with the benchmark reaching its highest level since December 2023. The driving force behind this price surge was the strong demand from the power sectors in both India and China, with China's coal imports reaching record monthly levels in September. In contrast, the price of South African coal remained relatively stable in the last 2 quarters, impacted by decreasing exports to India and the introduction of discounted Russian coal supplies. This disparity highlights the regional variations and the complex interplay of supply and demand that shape the global coal market. After a significant spike in mid-2022, coal prices fell considerably in the following year before stabilizing, though they remain elevated. The Australian benchmark in September 2024 was approximately 75% above its 2015-19 average, underscoring the persistent challenges facing the industry. On the demand side, global coal consumption in the first half of 2024 was 1% higher than the same period the previous year, with power sector demand being the primary driver. India led this increase, as a heat wave spurred record demand for air conditioning, which, combined with reduced hydropower output, placed greater reliance on coal-fired power generation. In China, thermal power generation, including coal, rose modestly by 1.5% in 2024 H1, as renewable energy sources such as solar, wind, and hydropower met a significant portion of the increase in electricity demand. Conversely, coal consumption in Europe is estimated to have decreased in 2024 H1, while remaining steady in the United States. On the supply side, global coal output is estimated to have decreased in 2024 H1, year-over-year, primarily due to declining production from China and the United States. The reduction in Chinese supply was largely attributable to stricter regulatory constraints introduced to address the rise in mining accidents following previous increases in production targets. In contrast, coal output in India rose by 10% in 2024 H1, a slower pace compared to the 17% growth recorded in the same period the previous year, but still reflecting a rapid expansion driven by rising power demand and efforts to bolster energy security. The world's largest coal exporter, Indonesia, saw a production increase of around 9% in 2024 H1, while output in the United States decreased by 17%. Russia's coal supply remained largely unchanged during this period. These shifts in supply and demand dynamics have had a significant impact on the global coal market, contributing to the observed price volatility in regional variations. Policymakers, industry stakeholders, and consumers must navigate these complex market conditions to ensure a reliable and sustainable energy future. Section: Agriculture. The global agricultural commodity market has been facing a mix of challenges and opportunities in recent years. The prices of various agricultural commodities have experienced fluctuations, driven by a combination of factors, including weather conditions, supply and demand dynamics, and geopolitical tensions. In September and the first half of October of 2024, several agricultural commodity prices saw a slight increase, largely due to reports of unfavorable weather conditions in key exporting countries. Despite this temporary uptick, the overall World Bank's agricultural commodity price index declined by 3% in the third quarter of 2024. However, the index is expected to be 2% higher in 2024 compared to the previous year, driven by a significant 58% spike in beverage prices and a 4% increase in raw material prices. This increase was partially offset by a 9% decline in food prices. Looking ahead, the agriculture price index is forecast to decrease by 4% in 2025, as a result of favorable growing conditions in major exporting nations. The market is expected to stabilize in 2026 as supply and demand come into better balance. Food prices are anticipated to soften by a further 4% in 2025 and then level out in 2026, while beverage prices are projected to decline by 9% in 2025 and an additional 3% in 2026. Raw material prices, on the other hand, are expected to remain broadly stable over the next 2 years. The outlook for the agricultural commodity market is subject to a range of risks, both on the upside and downside. Upside risks include the potential impact of heat waves, biofuel policies that favor higher blending mandates, and geopolitical tensions that could push energy and fertilizer prices higher. Downside risks include lower than expected crude oil prices, which could reduce demand for biofuel feedstocks, and the onset of a strong La Niña weather pattern. To navigate these uncertainties, market participants, policymakers, and industry stakeholders must closely monitor the evolving dynamics in the agricultural commodity market. Robust risk management strategies, proactive supply chain adjustments, and informed decision-making will be crucial in ensuring the stability and resilience of the global food system. Section: Food Commodities. Here is a technical article based on the provided text, with expanded content and a revised structure. The Global Food Commodity Landscape, Navigating Shifts and Trends. In the ever-evolving world of global food commodity markets, understanding the intricate dynamics and factors shaping price movements is crucial for stakeholders, policymakers, and industry participants. The recent insights provided in the Commodity Pricing Outlook by the World Bank 2024 report shed light on the nuanced developments within the food commodities sector, offering a comprehensive perspective on the state of the market. One of the key observations highlighted in the report is the fluctuations in food commodity prices, which experienced a mixed trend in the latter half of 2024. Following news of adverse weather conditions in various regions, including dry weather in South America and excessive wetness in Canada and the European Union, prices of food commodities saw a modest increase in September and the first half of October. However, the overall trend painted a different picture, as the World Bank's Food Price Index registered a decline of approximately 3% in 2024 Q3, quarter-over-quarter, settling at a level 8% lower than the previous year. This downward trajectory was largely driven by a significant 6% decline in grain prices during 2024 Q3, which pushed prices to a level 15% below the 2023 Q3 benchmark. Both maize and wheat, as staple food commodities, followed suit, with prices declining by 8% and 6% respectively, reaching 4-year lows and dropping around 20% compared to the previous year. The primary factors contributing to this price decline can be attributed to record-high maize production in the 2023-24 season and favorable crop expectations for the current season, exerting downward pressure on prices. Similarly, rice prices also witnessed a decline in October, as harvests arrived in key exporting countries and India eased its export restrictions, following a 5% fall in 2024 Q3, quarter-over-quarter, to levels slightly lower than a year earlier. Global rice production rose by approximately 1% in the 2023-24 season, reaching a new record high. The oils and meals price index also experienced a modest decline of 1% in 2024 Q3, quarter-over-quarter, reaching a level 11% lower than the previous year. This was largely driven by a 13% drop in soybean prices in 2024 Q3, reaching a level almost a third lower than in 2023 Q3, and a 3% dip in soymeal prices. However, these declines were partially offset by increases in soybean oil and palm oil prices of 7% and 5% respectively. The record-high global soybean production, with Argentina's crop rebounding and growing output in Canada, China, and Europe, contributed to the downward pressure on soybean prices. Conversely, the hot and dry conditions in the EU and the Black Sea region caused crop losses in sunflower seeds and rapeseed, increasing the demand for soybean oil and supporting its price rise. The Other Foods Price Index, which includes commodities like sugar, meat, and fruits, also moved lower by 2% in 2024 Q3, quarter-over-quarter, but remained slightly above year-earlier levels. This decline was driven by a 1% dip in sugar prices and a 4% decrease in chicken prices, partially offset by a 6% rise in beef prices. Improved sugarcane harvests in major producing countries, coupled with falling crude oil prices, which reduced the demand for the conversion of sugarcane to ethanol, contributed to the weakness in sugar prices. However, sugar prices picked up in September and early October due to supply concerns in Brazil, where dry weather and fires damaged sugarcane fields. The divergent trends observed across different food commodity segments highlight the complexity and interconnectedness of the global food market. Factors such as weather patterns, production dynamics, trade policies, and shifting consumer preferences all play a crucial role in shaping the overall landscape. As the industry navigates these evolving market conditions, stakeholders must remain vigilant, closely monitoring key indicators and adapting their strategies to capitalize on emerging opportunities and mitigate potential risks. Section: Implications for Food Security and Food Price Inflation. Here is a technical article based on the original text from the book, Commodity Pricing Outlook by World Bank 2024. The global food security landscape has faced significant challenges in recent years, with the prevalence of undernourishment remaining steady at around 9% globally since 2017. This worrying trend is particularly acute in certain regions, with 1 in 5 people in Africa, 1 in 13 in Asia, and 1 in 17 in Latin America and the Caribbean facing chronic undernourishment as of last year. The sheer scale of the problem is staggering, with more than 730 million people affected by hunger globally in 2023, including 385 million in Asia and almost 300 million in Africa. Projections by the United Nations Food and Agriculture Organization paint an even more dire picture, estimating that the number of undernourished people will reach 735 million globally by 2025 and exceed 580 million by 2030. These figures underscore the significant distance the world must travel to achieve the Sustainable Development Goal of zero hunger by 2030. The reasons behind this persistent and worsening food insecurity are multifaceted and complex. Armed conflicts, extreme weather events, and economic shocks have all played a role in eroding local access to food in many vulnerable countries, often serving as the primary drivers of acute food insecurity. In these crisis settings, weak local market functioning, security issues, and governance fragilities can limit the extent to which lower global food prices translate into improved household food affordability. However, there are some glimmers of hope on the horizon. Recent and projected declines in global food commodity prices are expected to feed through to domestic food price inflation to varying degrees in the coming year, potentially bolstering food affordability and helping to attenuate food insecurity in some contexts. In 2024 Q3, the median 12-month rate of domestic food price inflation globally was 3.6%, down from around 8% a year earlier. The regional picture, however, remains uneven. While food price inflation declined in 2024 Q3 from 2024 Q2 in East Asia and the Pacific, South Asia, and Sub-Saharan Africa, it edged up in Europe and Central Asia, Latin America and the Caribbean, and the Middle East and North Africa. Moreover, food price inflation continues to outpace headline inflation by at least 4 percentage points in several countries, including Argentina, Burkina Faso, Chad, Guatemala, Malawi, Maldives, Niger, Nigeria, Paraguay, Togo, and Vietnam, indicating a decline in food affordability relative to other goods and services. The implications of these trends are far-reaching, underscoring the urgent need for concerted global action to address the underlying drivers of food insecurity and ensure that the benefits of declining food commodity prices are equitably distributed. Policymakers must prioritize strengthening local food systems, improving supply chain resilience, and providing targeted support to the most vulnerable populations to mitigate the devastating consequences of hunger and malnutrition. As the world grapples with the complex challenges of food security, the lessons learned and the strategies employed in the coming years will not only shape the path towards the Sustainable Development Goal of zero hunger but also have profound implications for the overall well-being and prosperity of communities around the globe. Section: Beverages. The global commodity market has been a subject of significant interest, particularly in the context of the beverage industry. The World Bank's recent report on the Commodity Pricing Outlook by World Bank 2024 provides a comprehensive analysis of the developments and outlook for the beverage sector. The report highlights that the World Bank's Beverage Price Index experienced a decline of nearly 6% in 2024 Q3, quarter-over-quarter, primarily due to a drop in cocoa prices, which more than offset the recent gains in coffee prices. However, the index remains 65% higher than a year ago, driven by earlier surges in the prices of Robusta coffee, Arabica coffee, and cocoa. The report further suggests that the index is expected to fall by 9% in 2025 and slide an additional 3% in 2026 as coffee and cocoa production recovers. The report delves into the coffee market, noting that prices reached multi-year highs in 2024 Q3. Arabica prices rose by 11% in 2024 Q3, standing more than 40% higher than a year earlier, while Robusta prices gained 16% in the quarter, reaching a level in September double that of a year earlier. The report attributes these price increases to significant risks to global coffee supply, including concerns over Brazil's Arabica production due to adverse weather conditions in August. Despite an expected increase in global coffee production to 173 million bags in the next season, this figure will still be considerably lower than the levels seen in 2020-21. The lingering impact of a major production shortfall in 2021-22, combined with steady demand growth of around 1% annually, has kept prices elevated. The report forecasts that Arabica prices will decline by 8% in 2025 before stabilizing in 2026, while Robusta prices are expected to drop by a similar magnitude as Arabica in 2025, with a further 7% decrease in 2026. However, the report also highlights key risks to this outlook, including the potential for worsening weather conditions in South America and the emergence of La Niña, which could adversely affect production in South America and East Asia. The report also examines the cocoa market, noting that cocoa prices fell by 20% in 2024 Q3 but were still nearly double their level in 2023 Q3. This decline has been partly driven by favorable weather conditions in West Africa, which have improved supply expectations. Global cocoa production is estimated to have decreased by about 14% in the 2023-24 season, falling to 4.2 million metric tons, MMT, from 4.9 MMT in 2022-23, primarily due to lower output in Côte d'Ivoire and Ghana, which account for almost 60% of global cocoa production. The report expects cocoa supply conditions to improve in 2024-25, especially in Côte d'Ivoire, where better weather could boost output by as much as 15%. Nevertheless, with limited supply increases anticipated from other regions, cocoa prices will remain elevated. The report forecasts that after a projected doubling of prices in 2024, cocoa prices will ease in the coming years, by around 13% in 2025 and 2% in 2026, although a return of unfavorable weather in West Africa is a key upside risk to this price outlook. The report also discusses the tea market, noting that tea prices, 3-auction average, rose by almost 4% in 2024 Q3, quarter-over-quarter, reaching a level 20% higher than a year earlier. This moderate rise in average tea prices reflects, in part, lower production from South Asian producers, including India, down 13% in the first half of 2024 compared to the first half of 2023, Bangladesh, -8%, and Sri Lanka, -5%. Meanwhile, in Kenya, the world's leading tea exporter, production increased by 25% over the same period due to improved weather conditions. The report suggests that following an estimated 13% increase in 2024, tea prices are set to remain fairly flat in 2025, as a limited recovery in supplies in South Asia, especially India, and East Africa, notably Kenya, is balanced by subdued demand growth, particularly in the Middle East. The comprehensive analysis provided in the World Bank's report offers valuable insights into the dynamics and outlook of the global beverage market, highlighting the complexities and interdependencies that shape the commodity pricing landscape. Section: Agricultural Raw Materials. The agricultural raw material market has been a subject of significant interest in recent years, as it plays a crucial role in the global economy. The World Bank's Agricultural Raw Material Price Index, which serves as a barometer for the industry, has shown some interesting developments in 2024 and the projected outlook for the next 2 years. In the third quarter of 2024, the index remained relatively unchanged compared to the previous quarter, quarter-over-quarter. This stability can be attributed to a mix of factors, where gains in the prices of natural rubber and some timber products were offset by declines in other components, notably cotton and tobacco prices. The projected outlook suggests that the index is expected to edge up in each of the next 2 years, supported by firm demand. One of the key drivers behind the recent changes in the agricultural raw material market is the performance of cotton. Cotton prices fell by more than 6% in 2024 Q3, quarter-over-quarter, reaching a level 15% lower than a year earlier. This decline can be attributed to weakening demand and strong production prospects for the 2024-25 crop season, which has just begun. According to the latest U.S. Department of Agriculture assessment, October, global cotton production is expected to rise by 4% in the 2024-25 season, driven by significant output surges in Brazil, plus 15%, Turkey, plus 25%, and the United States, plus 33%. These increases will outweigh declines in India, minus 6.5%, and Pakistan, minus 10%, the world's dominant suppliers. While global consumption is set to increase by 2.3%, the global stock-to-use ratio is expected to stay steady at around 70%. After a decline of nearly 10% in 2024, cotton prices are projected to rebound in 2025 and 2026 as supply growth moderates. Key downside risks to this outlook are weaker than anticipated global economic growth and higher than anticipated global production. Another notable development in the agricultural raw material market is the performance of natural rubber. Natural rubber prices have risen for 4 consecutive quarters, reaching $1.76 per kilogram in 2024 Q3, more than 30% higher than a year earlier. This price increase can be attributed to weather-related supply disruptions, including reduced rainfall in Southeast Asia, the primary producing region. Production declines in Thailand, of more than 8% in the 12 months ending August 2024, compared to a year earlier, and Indonesia, minus 13%, the world's largest producers, were only partly offset by output gains in Côte d'Ivoire, plus 18%, and other producers, plus 3%. Demand for natural rubber remains solid, growing by 2% in the 12 months ending August 2024. In 2024 Q2, global tire production, which accounts for nearly 2/3 of natural rubber consumption, was 5.8% higher than in the same quarter of last year, reflecting robust automotive sector demand. Following a projected increase of 27% in 2024, natural rubber prices are expected to rise 3% in the next 2 years. However, a potential downturn in automobile production, particularly due to a supply glut in China, poses a significant downside risk to the forecast. The agricultural raw material market is a complex and dynamic sector, with various factors influencing its performance. The World Bank's Agricultural Raw Material Price Index provides valuable insights into the trends and outlook for this critical component of the global economy. As the industry navigates the challenges and opportunities ahead, Stakeholders will need to closely monitor the evolving market conditions to make informed decisions and adapt to the changing landscape. Section: Fertilizers. The fertilizer market has been a topic of significant interest in recent years, with various factors influencing the overall dynamics of supply, demand, and pricing. The World Bank's latest report on the commodity pricing outlook for 2024 provides a comprehensive overview of the developments and outlook for the fertilizer market. According to the report, the World Bank's fertilizer price index rose by more than 5% in 2024 Q3, quarter-over-quarter, primarily driven by a jump in urea prices. However, it is important to note that despite this increase, prices remain 22% below the level of a year earlier, reflecting increased production and lower feedstock prices. This shift in the market dynamics has also led to an improvement in the fertilizer affordability index, which has returned to its 2015-19 average level as of September 2024. Looking ahead, the report projects a 24% drop in the fertilizer price index for 2024 as a whole, which is consistent with the decline in prices of natural gas, a crucial input for the production of fertilizers. This downward trend is expected to continue into 2025, with prices projected to weaken further before stabilizing in 2026. However, it is worth noting that the projected prices are still expected to remain above the 2015-19 levels, reflecting the ongoing strong demand and the impact of export restrictions, particularly by China, which aims to ensure sufficient domestic supplies. Delving deeper into the specific fertilizer types, the report highlights the dynamics in the nitrogen, urea, market. Urea prices rose by nearly 9% in 2024 Q3, quarter-over-quarter, though they were still 7% lower than a year earlier. This recent increase is attributed to the ongoing reduction in China's exports, which declined by nearly 85% for the first 8 months of 2024 compared to the same period in 2023, as well as production shortfalls in Egypt due to declining domestic natural gas production. Despite these short-term challenges, the report expects urea prices to decline by a further 8% in 2024 before stabilizing in 2025, as production is expected to grow, particularly in East Asia and the Middle East. The report also examines the trends in the diammonium phosphate (DAP) market, where prices increased slightly in 2024 Q3, quarter-over-quarter, standing more than 8% higher than a year earlier. This relative strength in DAP prices compared to other fertilizer types is partly attributed to export restrictions on phosphate from China and ammonia from Russia, which have disrupted global trade. This impact is particularly noticeable in Europe, where imports from China and Russia have been replaced by higher-cost supplies from exporters such as Egypt, Morocco, Saudi Arabia, and the United States. However, despite the continuing export restrictions, the report notes that export quantities rose in July and August, putting annual exports on a trajectory that is little changed from last year. The muriate of potash (MOP) market has also seen some interesting developments, with prices falling by more than 4% in 2024 Q3, quarter-over-quarter, reaching levels nearly 16% lower than a year earlier. This decline is attributed to seasonally weak demand and robust exports, particularly from Belarus and Russia, which have continued to export despite sanctions on the former. The report also highlights the gradual recovery in MOP demand, which is expected to return to pre-2022 levels by early next year. Looking ahead, the report projects further declines in MOP prices, with a 23% drop expected this year and a more modest 2% decline next year, before leveling out in 2026 as demand strengthens. Potential downside risks to prices include further expansion of Belarusian exports through alternative trade routes and the introduction of significant new production capacity, especially from Canada. Overall, the World Bank's commodity pricing outlook for 2024 paints a complex and dynamic picture of the fertilizer market, with a mix of factors influencing supply, demand, and pricing. While the report highlights some positive trends, such as the improvement in affordability and the expected declines in prices, it also underscores the ongoing challenges and potential risks that could impact the market in the coming years. Section: Metals and Minerals. The global commodity markets have witnessed a roller coaster ride in recent times, with metal prices exhibiting a short-lived rally following China's stimulus announcements in late September. This rally came on the heels of a 7% drop in metal prices during the third quarter of 2024, a decline driven by subdued industrial activity across major economies. Looking ahead, the World Bank's latest commodity price outlook suggests that the Metal and Minerals Price Index is projected to increase by 4% in 2024, compared to the previous year. However, this upward trend is expected to be short-lived, with the index inching lower in 2025 and then declining by 3% in 2026. The precious metal market, on the other hand, is expected to remain more stable in the near term. Prices for precious metals, such as gold, are forecasted to remain relatively stable next year, before edging down in 2026. This follows a significant 21% increase in precious metal prices during 2024. The outlook for the metal and mineral markets is subject to a range of upside and downside risks. On the upside, further stimulus measures that benefit metal-intensive sectors in China, potential production disruptions, and new trade restrictions that could tighten supply, as well as escalating geopolitical tensions that could drive up demand for safe haven assets like gold, could all contribute to higher-than-expected prices. Conversely, weaker-than-expected economic growth in major economies could dampen the demand for metals, leading to prices falling below the current forecasts. This scenario could be exacerbated by a slowdown in industrial activity or a shift in consumer preferences away from metal-intensive products. Navigating these complex and volatile commodity markets requires a deep understanding of the underlying trends, the impact of geopolitical and economic factors, and the potential risks and opportunities that may arise. Policymakers, industry stakeholders, and investors must closely monitor these developments and adapt their strategies accordingly to ensure resilience and success in an ever-evolving global marketplace. Section: Base Metals and Iron Ore. Commodity prices in flux, navigating the complexities of the metal market. The global commodity market has experienced a roller coaster of events in recent years, with metal prices fluctuating amidst changing economic conditions and policy interventions. The World Bank's 2024 Commodity Pricing Outlook report provides a comprehensive analysis of the base metals and iron ore market, offering insights into the drivers and trends shaping this dynamic landscape. In late September 2024, metal prices received a boost from policy measures implemented in China, which included monetary easing, housing market support, and liquidity injections for the stock market. These initiatives aimed to spur growth and stabilize the property sector, a crucial factor in China's economic landscape. However, the metal price rally was short-lived as uncertainty emerged regarding the scale and duration of future policy support in China. Prior to this, base metal and iron ore prices had declined in the third quarter of 2024, reflecting weaker-than-anticipated economic data releases from China, coupled with signs of moderating growth in the United States and continued industrial weakness in Europe. These developments had a significant impact on the prices of metals commonly used in construction and manufacturing, such as copper and iron ore. Looking ahead, base metal prices are projected to stabilize next year before declining in 2026. This projection is based on the expectation of steady supply growth counterbalanced by secular demand growth, including tailwinds from the ongoing energy transition. Aluminum prices, for instance, are expected to remain resilient over the forecast horizon, driven by the expanding use of renewable energy technologies and increased power grid infrastructure needs. In the case of copper, prices fell by 6% in the third quarter of 2024 due to signs of decelerating industrial activity in major economies. However, supply concerns have eased as major producers, including Chile, have resolved labor disputes and increased output. Global copper supply is expected to rise steadily in the coming years, with additional output from Africa, South America, and other regions. Demand for copper is also likely to remain stable, as it is a crucial component in many energy transition technologies, such as electric vehicles, renewable energy systems, and grid infrastructure. Lead prices, primarily used in battery production, have been less affected by the cyclical demand fluctuations seen in other industrial metals. After an expected 2% decline in 2024, lead prices are projected to edge down another 2% in 2025, mainly due to rising mine supplies from various regions. Nickel, on the other hand, experienced a 12% price decline in the third quarter of 2024, reflecting growing production and signs of weakening demand from the stainless steel and battery markets. Tin prices inched lower in the third quarter of 2024, following a significant surge in the previous quarter due to supply disruptions from major producers in Indonesia and Myanmar. With few new tin mining projects in development, global supply is likely to remain tight in the coming years, leading to projected price increases of 7% in 2025 and 6% in 2026. Zinc prices, mainly used in the galvanization of steel for construction, manufacturing, and infrastructure, dipped by 2% in the third quarter of 2024 due to subdued demand in major economies. However, prices are expected to partially rebound as sentiment regarding construction-related demand in China improves. The ramp-up of several large mine projects globally is likely to result in ample zinc supply, leading to forecast price declines in 2025 and 2026. Finally, iron ore prices declined by 12% in the third quarter of 2024, reflecting softening steel demand, notably in China, amid plentiful supplies. The likelihood of continued softness in China's property sector and steady growth in iron ore production from Australia, Brazil, and West Africa are expected to exert further downward pressure on prices in the coming years. The World Bank's Commodity Pricing Outlook report highlights the complex interplay of factors shaping the base metals and iron ore market, underscoring the need for industry participants to closely monitor and adapt to the evolving landscape. As the energy transition and global economic trends continue to shape the demand and supply dynamics, understanding these nuances will be crucial for businesses and policymakers to navigate the challenges and capitalize on the opportunities in the metal commodities market. Section: Critical Minerals. The recent trends in the critical mineral market have been characterized by significant volatility and shifting dynamics. In the third quarter of 2024, the prices of critical minerals experienced a notable decline, with cobalt and lithium prices plummeting by 18% and 25% respectively, on a quarter-over-quarter basis. Conversely, the prices of rare earth metals saw a 5% increase during the same period. The price declines for cobalt and lithium can be attributed to the continued growth in supply from key producers, who have been able to meet the rising demand driven by the ongoing energy transition. This surge in supply has outpaced the demand, leading to a downward pressure on prices. However, the rise in rare earth metal prices is largely due to concerns over potential export restrictions by China, particularly on antimony, a critical mineral used in the manufacture of batteries, solar panels, smartphones, and even weaponry. Looking ahead, the outlook for critical mineral prices remains complex. While they are expected to remain depressed in the near term, the long-term trend is likely to see a rise in prices as the demand for energy transition technologies, such as electric vehicle, EV, batteries and other clean renewable energy solutions, continues to expand. This growing demand is expected to outpace the supply growth, which could lead to a tightening of the market and an upward pressure on prices. Despite the falling prices, the industry has not seen a significant reduction in investment in new mineral supplies. In fact, exploration spending has continued to grow, with Australia and Canada leading the way. Furthermore, major economies, including the United States and the European Union, have introduced various incentives and policy measures to boost domestic critical mineral production. However, the future supply growth could face constraints due to a range of factors. Environmental concerns, the long lead times associated with the development of new mines, and the potential for further increases in trade restrictions on critical minerals, whose mining and processing remain geographically concentrated, could all pose challenges to meeting the growing demand. In conclusion, the critical mineral market is navigating a complex landscape, with short-term price declines contrasted by an expected long-term rise in demand and prices. The industry's response, including continued investment in exploration and the introduction of policy incentives, aims to address these challenges and ensure a sustainable supply of critical minerals to support the energy transition and other crucial technological advancements. Section: Precious Metals. Precious metal market dynamics and outlook. The precious metal market has experienced significant shifts in recent quarters, with gold, silver, and platinum prices exhibiting distinct trends and drivers. The World Bank's commodity pricing outlook for 2024 provides a detailed analysis of the factors shaping the precious metal market, offering valuable insights into the industry's future trajectory. Gold prices have been on a remarkable run, reaching new nominal highs in October 2024. This surge was driven by a confluence of factors, including heightened geopolitical tensions, sustained demand from central banks, and the onset of monetary easing in the United States. The weakening of the US dollar and lower government bond yields contributed to the bullish sentiment surrounding gold, with investors seeking the metal as a safe haven asset. Additionally, a resurgence in demand from exchange-traded funds, ETFs, further propelled gold prices higher in the third quarter of 2024. Looking ahead, robust safe haven demand for gold is expected to persist in the near term, supported by ongoing global uncertainty. However, demand from central banks and the jewelry sector, which account for 2/3 of global gold consumption, is likely to moderate as prices reach record levels. Nevertheless, gold prices are forecast to increase by 21% year-over-year in 2024, remaining around 80% higher than the 2015-19 average throughout the forecast period, with only a modest decline of 1% in 2025 and 3% in 2026. The silver market has also experienced a resurgence, with prices increasing by 2% in the third quarter of 2024 and extending their gains in October. The onset of U.S. monetary policy easing has been a key driver, fueling investment demand for the metal. Looking ahead, silver's dual role as both a financial and industrial asset is expected to support steady demand growth. Expanding solar panel installations and increasing vehicle electrification are projected to drive the expansion of industrial silver usage. While global silver supply is expected to grow modestly in the next couple of years, driven by production increases in major producing regions, the lagging supply growth relative to robust demand is likely to push silver prices higher. The World Bank forecasts a 20% increase in silver prices in 2024, followed by further gains of 7% in 2025 and 3% in 2026. In contrast to gold and silver, platinum prices experienced a 2% decline in the third quarter of 2024, reflecting subdued activity in the automotive sector, a major end user of the metal. Additionally, the narrowing price gap between platinum and palladium has limited the demand for platinum as a substitute in autocatalyst manufacturing. Going forward, the gradual shift towards battery electric vehicles is expected to dampen the growth of auto-linked platinum demand, which accounts for 2/5 of the metal's usage. However, tighter mine supply, particularly in South Africa, and decreasing recycled supply from the automotive sector are projected to support a 4% increase in platinum prices in 2024, followed by further gains of 5% in both 2025 and 2026. The divergent trends observed in the precious metal market highlight the complex interplay of factors shaping the industry. While geopolitical tensions, monetary policy, and technological shifts are driving demand dynamics, supply-side considerations, such as production capacity and recycling trends, are also crucial in determining price trajectories. Investors, policymakers, and industry stakeholders will need to closely monitor these developments to navigate the evolving landscape of the precious metal market. Chapter: Special Focus Commodity Price Synchronization, A New Era. Section: Introduction. Commodity Price Synchronization, A Deeper Exploration. Commodity markets have long been characterized by periods of heightened price synchronization, particularly during times of global economic upheaval. The past 5 decades have witnessed several such episodes, with the most recent occurring in the aftermath of the COVID-19 pandemic and the preceding global financial crisis, GFC. The widespread collapse in commodity prices in early 2020, driven by the pandemic-induced global recession, was followed by a broad-based rebound, with several commodities reaching record-high prices. This synchronized variation in commodity prices is not a new phenomenon. A similar upswing was observed in the early 2000s, fueled by rising commodity demand from emerging market and developing economies, EMDEs, especially China. Researchers have attributed this price synchronization to fluctuations in the global business cycle, which represents a common underlying component driving commodity prices. However, developments specific to individual commodities can also create a perfect storm, where distinct factors align to cause price movement. During the post-pandemic recovery, as commodity prices surged due to rebounding economic activity, a series of disparate shocks further intensified price pressures, such as geopolitical risks, like the Russian invasion of Ukraine, and extreme weather events that strained agricultural yields. Spillover effects can also contribute to the synchronization of commodity price movements. For instance, price fluctuations in energy, a key input in metal production and agriculture, can increase costs across sectors, both directly, as fuel costs, and indirectly, through chemical and fertilizer prices. Similarly, elevated crude oil prices can incentivize increased production of biofuels, increasing demand and prices for biofuel feedstocks. The effects of synchronized commodity price movements on global economic activity and inflation can vary depending on the underlying drivers. Technological advancements that increase productivity in non-commodity sectors can boost demand for inputs such as energy and metals, leading to a rise in both commodity prices and global output. Conversely, commodity price spikes driven by geopolitical tensions may have a more pronounced inflationary effect but result in a relatively transitory drag on economic activity as the shocks dissipate or alternative supply chains emerge. This analysis explores the dynamics of synchronized cycles in commodity prices and their underlying drivers, comparing the pandemic-induced global recession of 2020 with the global financial crisis of 2009. The findings suggest that a common component has explained a significant portion of fluctuations in commodity prices, particularly in the energy and metals sectors, which are closely linked to industrial activity. Global demand shocks, such as fiscal support or shifts in consumer preferences, can increase commodity prices by up to 4.8% over 6 months, while global supply shocks and commodity-specific shocks, such as conflicts in key producing regions, have a stronger and more persistent impact, raising prices by 10.3% and 6.2%, respectively, within 7 months. Interestingly, during the recovery from the global recession of 2020, commodity-specific shocks, including heightened geopolitical tensions, contributed significantly to the rebound in commodity prices, in contrast with the price swings during the global recession of 2009 when such shocks played a less important role. As the post-COVID-19 period progresses, the analysis reveals that greater price dispersion has started to return, tempering the peak synchronization observed from the early 2020s to mid-2022. However, the risk of synchronized price increases due to an escalation in geopolitical tensions remains a significant concern, as broad-based price rises can limit consumers' ability to substitute toward lower-priced goods, amplifying welfare losses and reducing the effectiveness of inflation mitigation efforts. The insights gleaned from this exploration of commodity price synchronization can inform policymakers and market participants in navigating the complex dynamics of global commodity markets, particularly in the wake of the COVID-19 pandemic and the evolving geopolitical landscape. Section: Methodology in Data. Commodity price synchronization, uncovering the drivers of global commodity market dynamics. The study of commodity price dynamics has long been a topic of interest for economists and policymakers alike, as understanding the factors that drive these fluctuations can have significant implications for economic planning, resource management, and investment strategies. In a recent analysis, the World Bank's Commodity Pricing Outlook for 2024 delves into the intricacies of commodity price synchronization, shedding light on the complex interplay between global economic conditions and the behavior of commodity markets. The researchers employed a dynamic factor model, as proposed by Coase, Otrock, and Whiteman, 2003, to estimate a common factor that captures the joint variation across a diverse set of 35 monthly commodity price series. This approach allows for the identification of the underlying drivers of synchronized movements in commodity prices, providing a more holistic understanding of the forces shaping global commodity markets. To further explore these dynamics, the authors estimated a structural vector autoregression (SVR) model incorporating three key variables: global consumer price inflation, global industrial production growth, and a common commodity factor derived from the dynamic factor model. By imposing sign restrictions from the existing literature, the researchers were able to distinguish between three distinct types of shocks that can influence commodity prices: global demand shocks, global supply shocks, and commodity-specific shocks. Global demand shocks, such as shifts in consumer preferences, exogenous fiscal stimulus, or unexpected monetary policy changes, are found to drive up global economic activity, inflation, and commodity prices in tandem. In contrast, global supply shocks, stemming from advancements in technology, productivity growth in emerging markets and developing economies, EMDEs, or trade liberalization, tend to increase global industrial production while reducing global inflation. These supply-side factors also lead to increased global consumption of commodities, ultimately resulting in higher commodity prices. Importantly, the researchers highlight that the global demand and supply shocks examined in this framework differ significantly from the commodity-specific shocks investigated in previous studies, such as those by Killian and Murphy, 2014, and others. While both types of global shocks can lead to increases in commodity demand and prices, the key distinction lies in the direction of global inflation. Commodity-specific shocks, such as natural disasters, geopolitical tensions, or speculative trading, are found to drive up commodity prices and global inflation while decreasing global economic activity. The methodology employed in this analysis is designed to focus on the links between short-term fluctuations in the global economy and global commodity markets, rather than long-term trends. The researchers argue that this approach provides valuable insights into the complex dynamics that shape the synchronization of commodity prices, which is a crucial consideration for policymakers, investors, and businesses operating in the global commodity landscape. By disentangling the various shocks that can influence commodity prices, this study offers a nuanced understanding of the forces driving these market dynamics. The findings highlight the importance of distinguishing between global demand, global supply, and commodity-specific shocks when analyzing